Hi, I'm Clayton from Squire Wealth Advisors, and with me today I have Nathan Larsen, who's one of our partners over the Squire Wealth Management Group. Nathan, thanks for joining.
Yeah, happy to be here.
Yeah, so we wanted to go over 2022, what happened in the markets in 2022, talk a little bit about inflation, because that's kind of the buzzword right now, and get into what is this? How does this impact our portfolios? How can we look at our portfolios and kind of going forward from all this? So Nathan, hit us off. Tell us a little bit what happened last year in 2022.
Yeah, as you probably know, we had a rough year in the markets in 2022. We're going to show some slides here, but the U.S. market in general, the stock market, was down just under 20%. The international developed market did a little better, but it was still down 14%. Emerging markets was down 20%. Real estate was down over 20%. And probably the hardest part about last year was the hit that bonds took. So bonds were down quite a bit, around 13% or 10% on the global level. And that's really tough. We look to bonds as a risk reducer and a stabilizer in our portfolios, and having that performance in bonds was difficult. The good news with bonds, though, is interest rates have come up, and so instead of earning 1 or 2% on bonds, we can expect to earn a little bit more now. And so those rates will the yields that our portfolios earn will start to come up. Looking longer term, it's been a great run. We've had some challenges economically and politically, but the market still has provided positive returns for the most part over the 5 and 10 year periods. So, there is hope for the future, and a down year about every 7 years or so, the market has a 20% correction. We can't time when those are, and so we stay diversified and take a long-term approach.
And if I may, Nathan, 2022 was an unusual year. It's not common for stocks and bonds to all be down, right? They don't have a perfectly inverse relationship, right? But it's common when you have stocks down, bonds are up, or vice versa. Very unusual to have them both down and down as much as they were. So it was an unusual year for sure.
Yeah, that's a good point. And the bonds, it's really interest rate driven. So we had really low interest rates for so long. Inflation started to creep in, and so naturally the Federal Reserve raises rates. And whenever that happens, we're kind of, rates aren't even high. Like, we've just raised them from really, really low to kind of more normal. And that did take a hit on bonds, but like I said, the good news is that in the future, we're actually earning some reasonable interest on bonds and fixed income. So,
yeah, that's a great point. So talk a little about inflation, Nathan. Tell us about what can we expect? What's the market telling us about inflation?
Yeah, so inflation's been very high. Everybody knows this. We had high gas prices, really, really rampant high inflation. Looking forward, though, the Federal Reserve has taken some pretty aggressive actions, and the market as a whole is kind of predicting that we're going to come back to normal with inflation. So, over the one year to the next 20 years, the market's really predicting kind of a normal inflation around 2%, maybe 2.5%, something like that. The Federal Reserve is targeting inflation just around 2%. So it's hard to think this is going to happen, but we've already seen gas prices come down. There's other forces at work here that should start to tame inflation.
Yeah, no, that's great. So one of the things that I think is really helpful to look at, if we look at another slide here, we talked about how 2022 was not a good year, right? But when we look historically at what's happened in the past, after a 20% drop in the market, in the stock market, and what has happened in the following year, the data is pretty enlightening here to show you that it's not all doom and gloom, right? So if you look at the slide that we have, it's showing that, yes, there are years where the market continues to go down following a 20% drop in a given year, but there are a lot of years where it's an exceptional year in the stock market. And if you look at the very end of the slide in the dark blue, the average return the following year of a 20% drop is 12%, which is great. That's above the U.S. stock average of 10%, right? If you're looking at the S&P 500. So I think the message to our listeners is, yeah, it's not been great, but that's not what we expect going forward. We always expect a premium in the market when we're invested, right? Otherwise we wouldn't invest. And so there's hope there on the horizon that things are going to go better in the future.
Yeah, great point. I mean, this slide here really kind of shows us that in order to get that 10% average that the S&P 500's had, you really have to go through some of the years like we just had, where you're down 20, and then other years you might be up 20 or 30. But over time, really what's happened over the markets is investors have been rewarded for being patient and sticking with it. And definitely after a downturn, it's not the time to really panic and worry, because history tells us that there's usually a recovery. There always has been, and we expect there to be another one. And we've started to see that at the end of the fourth quarter in 2022, we had a pretty good rally, and so far this year we've had a decent rally. So, we don't know the future, but we know that history has rewarded investors for being patient and staying in the market.
Yeah, that's great. And I think that's a great segue kind of in the last point I want to talk about, this idea of what the cost of mistiming the market. We don't advocate for timing the market and trying to get in or get out and figure out what's going to happen. The research shows that's a loser's game, right? And if we look at this slide here, this graph showing us what's happened in the last 40 years, if you were to take $1,000 and hypothetically invest it in the stock market, that investment over 40 years would have grown to about $131,000. If you'd missed just the very best day, that return is now $117,000, and a dramatic drop if you missed the 5 best days, right? And so just trying to figure out, we think this is going to be a bad year, so let's take our money out. It just, you can see from the data, it doesn't fare well for investors.
Yeah, great point. It's a loser's game, and really, if you think about it, you would have to guess right twice. Like, you would have to guess when the right time to pull money out is. Then you again have to guess when the right time is to put money back in. And the real problem is that the market is so volatile on a daily basis, especially around these, difficult times that we've been facing. And so it's virtually impossible to time it. And the best approach is to do the right planning, work with your advisor, get the right investment plan and an overall risk strategy and tolerance in place, and then stick with it. Because I don't have a crystal ball, none of us do. We don't know when the good days are going to be, when the bad days are going to be. But over time, investors get rewarded for having a well thought out plan and sticking with it.
Yeah, no, that's great, Nathan. And the last, I think, data point I want to mention that just is very interesting to me. When you look at that slide that we have up, if you look at the last 20 years, 7 of the 10 best days occurred within 15 days of the 10 worst days. So they're really close. And so to try to get it out, it's just, you're going to miss some of those upside days that often are so close to the bad days. So the message that you're sharing with us, Nathan, and we totally advocate here at Squire, is have a good investment strategy, stick with it, and ride those ups and downs, because in the end, that's really the best strategy for your portfolio.
Yeah, that statistic is crazy. We kind of experienced this a bit last year. The market was actually down more than it ended up because we had that rally in the fourth quarter. Without that rally, like had an investor maybe panicked mid-year, they would have experienced way worse of a loss than if they would have just stuck with it the whole year. And even into this year, like as we're starting to see markets come up and performance improve, really the best approach is just to stick with a well thought out, diversified plan.
Perfect. Well, that's it. Thank you, Nathan, for joining us, and thank you for those watching here. If you have any questions, feel free to reach out to us. Our contact information will be in the notes below the video. You can reach out to us at Squire, either Nathan and I or anyone else, and happy to help and work you through your portfolio or your financial plan. So thanks, Nathan.
Yep. Thanks for the time.